Everybody, Don Wenner here. We'll be getting started in about a minute. It's about a minute till 4 Eastern. Thanks for jumping on. Our fourth segment of talking about what's going on in today's real estate market, what's going on here at DLP in the world of investing. And today's segment is going to be called Massive Action, focused around building your wealth. I'll myself, Don Wenner, be the host here again today. And excited to chat with you guys here. Let me get my video on and we'll get started in about 30 seconds. Reminder for everybody already on, you can type in any questions into the chat box. If you're in Zoom, you can type them into the chat function in social media. If you're on Facebook or any other platform. And we will go through a little presentation here, giving you guys some updates, and then we'll open it up to questions as we do each week here. Also, for anybody on, if you have any other, colleagues, friends, family members, associates, anybody you think would benefit from this type of information, feel free to share the link with them to join us. We have a lot of our existing investors who are joining us every week, as well as people who've been evaluating investing with us. We have fellow team members, we have borrowers and partners of ours on, vendors, suppliers of ours, all different types of people, different reasons why they want to, get another perspective and hear what's happening here with DLP. So we encourage you to share the link out and welcome people to join us. And with that said, we'll go ahead and get started. Larry dropped in the link if you want to share it out. And in that same link, you also can access, if you haven't seen any of our previous segments, you can access those recordings there as well in your chat box. So with that said, let's get rolling. First, I want to start off. I know one of the main questions that people want information on in this webinar, in this presentation, is what's going on with rent and mortgage payments. And those have been big hot topics heading into April. A lot of media, a lot of talk about how renters are not going to be able to pay their rent. Everybody isn't going to make their rent payments in April, and that most people weren't going to be making their mortgage payments. Lots and lots of talks about mortgage forbearance and just how terrible it's going to be in the month of April. So we, like everybody else, we're worried about, all the unemployment news we're hearing about, and worried about a large increase in delinquency. And so we spent a lot of time second half of March prepping our management teams, prepping our approach, our process to go about collections, putting incentives in place, putting a lot of focus around collections, both our rent payments and our mortgage payments on our loans. And through last Thursday, when we were a couple days into the month, I gave you guys some highlights to how it started off pretty well. And I'm really pleased to report that through yesterday, April 8th, we've collected about 82% of the rent for the month of April. And to put that in perspective, we're only about 2% off pace with where we were in the month of March, which ended up as our best month in 2 years. So we're not far off from last month. We're pretty much on pace with an average month. Doesn't mean it's not going to be more challenging than it normally is to collect from that 18% who has not yet paid. Doesn't mean there's not still challenges, but thus far, we've collected the majority of the rent. We have a lot of people who haven't paid on payment plans, and we have many people who haven't yet paid who are expected to pay once they get the stimulus checks, which we're hearing people are going to start getting direct deposit into their accounts as early as tomorrow. Haven't heard anybody receive them yet, but most expect that they'll have them next week, or certainly at worst the following week. So that should put us in pretty great shape here for April. We actually already have about 8 or 9% of our residents who've already paid their May rent as well. It's a small percent, but nonetheless a good step forward. So it's been much better than I think most would anticipate. And I've talked to a number of other large operators who we do business with, who we know, who own 10,000, 15, 20,000 apartments or homes. And most of them are a little bit higher than where we are so far, but are doing much better than where they expected to be. So even, I've seen lots of news articles saying a third of people haven't paid their rent, 50% of people haven't paid their rent, really high numbers. I think a lot of that is skewed and not accurate. And most we're hearing is the majority of people are still paying their rent, still paying their bills, just like any other month. On the loan payment side, on the mortgage payment side for the loans we make to real estate investors, it's actually gone really, really well. Out of all of our borrowers, the vast majority of our loan payments are due on the first of the month. And out of all those payments due on the first of the month, we have less than a handful here who have not yet paid. And we have the last round being pulled on the 10th. But thus far, the vast majority of our borrowers have paid. The few who haven't are working on making payments. We've been in communication with them all, and it's gone, again, pretty close to a normal month. Again, doesn't mean we're out of the weeds. Nobody knows exactly, how long things are going to continue. But so far, it's gone really, really well. Again, similar approach we took to rent. We had lots of communication with our borrowers before, April 1st, lots of assistance, support, guidance, and communication, and it's gone very, very well. So really, really pleased to be able to report on that. Another question that we've received here in the past week that I wanted to address here is, what do you believe the opportunity is going to be for borrowers going forward? So a lot of people have been asking, especially people who are investing or considering investing in our lending fund or our income and growth fund, is how's the long-term effect going to be? Are buyers still going to be able to, are borrowers still going to be able to find deals, and then when they buy property, they're still going to be able to sell them in this environment? And that's the other thing that's been maybe even more surprising than the percentage of residents and borrowers who've been able to make their payments is how active the market has remained. We're still leasing apartments. We're still increasing physical occupancy out in our rental portfolio. And on our single family home sales, both in DLP Realty, our real estate brokerage, and Bright Homes, our home building business, we're putting contracts under agreement, homes under agreement every day. In Bright Homes, we put 5 new homes under contract this past week. We're set to have April be our biggest month ever in closings. Things are going surprisingly really well. People still have the demand to move into new housing. The fact that our properties, such as Bright Homes, are vacant, just like any of our borrowers, when they renovate the homes, they're vacant. That's actually a huge advantage right now, because home sellers who live in their homes don't want showings, or or the buyers don't want to go into occupied homes. So we're getting an disproportionate amount of people looking at vacant homes. We've set up all of our properties with the ability to do virtual tours, self-showing lockboxes, things like that, to increase our amount of tours. In many properties we're selling, we're getting multiple offers right here, right now, even in Pennsylvania, where technically you're not even allowed to tour homes right now. So I believe with the lowest supply in almost every market we've ever had right now, the pent-up demand that is going to be in most of these markets, especially assuming the stay-at-home orders get lifted here in May. It's the heat of the spring market. It's going to be a great time for sales, and we feel very confident that our borrowers are going to be able to sell homes in this upcoming environment. Doesn't mean there won't be exceptions. Doesn't mean there might not be some financing challenges or different normal challenges that come out of this, or some new challenges that come out of this environment. But overall, feel very strong about the single family home market. We've been asking a lot, are we seeing any signs of the market stabilizing? I'll say overall, it's even though, overall, like I said, we're still seeing our as an organization, we're very active. We're doing all the same things we've always done with very few exceptions. Homes are still selling. We're still building homes. We're still getting them under contract. We're still funding loans. We're still leasing apartments. We're still collecting rent. So overall, we're doing very well. In terms of, things stabilizing, it is hard to know, what's going to happen from one day to the next in terms of how long this, government forced shutdowns continue. So I can't say in terms of the financial markets yet that things have stabilized, but we have seen a lot more lenders starting to have conversations, starting to talk about, closing loans in May, starting to talk about closing business in June, starting to set dates that they're going to be getting back to business. A lot of the groups that have been on the sidelines here through this. So we're starting to see a lot of that optimistic, positive talk, and people starting to put new deals back in their pipeline, starting to look at deals. So I think that's a positive sign that people are prepping for and expecting things to get back to normal here, or a new normal very soon. We get a lot of questions about our acquisitions, deals that we're buying. So we expect in Q2 here that we'll very likely only end up buying at most one apartment community this whole quarter. Coming into the quarter, we were expecting we were going to close on 5 or 6 communities, 80 to 100 million in new acquisitions this quarter alone. We may end up closing one deal where a deal we were already under contract on that we will only close if we get a significant discount on it. But otherwise, we've kind of pushed every deal we're working on out, extended our times out to evaluate the deals. Had no financial money sitting out there, and we're staying in lots of communication with sellers, with brokers, with deals we're already working on in all stages, including deals that we were in different stages of negotiation or under letters of intent. But we're going to wait and see how the market reevaluates pricing on the multifamily side. And we expect there's going to be a good amount of micro kind of distress situations that we're going to be capitalized on. So we're working to keep our money, our powder dry to capitalize on the very best deals, which we think there's going to be a tremendous volume of those opportunities come the second half of this year. So we haven't closed on any new multifamily acquisitions in the past since late February, and there's a great chance we won't close on any here in Q2, but expect to have a big second half of this year. And we got this question a few times here recently. Is this our first economic market downturn? So DLP was founded in 2006. I started the company right at the beginning stages of a market downturn. Actually, October 2006 in Pennsylvania was the peak of home prices before the Great Recession came. And that's when I got started in real estate. And so we grew our business through a distressed recessionary environment. And grew by over 60% every year through that environment, and continued that through this last whole cycle. So we've been through a very different cycle, because in the last cycle had a lot of true economic market, fundamental market issues that caused the last recessionary environment. This recessionary environment is, of course, originally caused due to a pandemic, and then really even more so being caused by government forced shutdowns. The fundamentals are still really, really strong, but no, we have been through a recessionary event of the great, recession here of 2008, 2009. So what we're focused on doing here at DLP, and this is what we've always been focused on, we call the 20-mile march. You're taking consistent, massive action, continuing to focus and understanding that there is going to continue to be through this, I think even more so now, an increased upswing on renting. As you see, this article here was an article that I wrote that Forbes published a couple weeks back about America, a rentership nation. If you type that into, you can find it on our website too. But if you type that in online, you'll find the Forbes article on this and explain why America has become and continue to move in the direction that people are choosing to rent. From the baby boomers, actually, is the biggest segment. The older generation is the biggest segment of growth in rentership, but certainly the younger generations as well. So we expect that to only continue as the financial markets are tighter here through this next cycle. And we want to be in a position to be able to capitalize on that shift in people choosing to rent. It's one of the big reasons why right before all this happened with coronavirus, we made the decision to start building Bright Homes for rent. And building a rental portfolio of brand new single family homes, because we see that as a significant opportunity and trend that people want to be able to live in beautiful brand new homes, but don't want the obligation of homeownership. We're continuing to stay focused on stable, affordable homes. We have focused on buying nicer, higher quality communities like that one in the picture. That's a community actually we own in Utah. The rents on that community are $600 to $800 a month, but it's a beautiful community, as you can see, built in the 2012, 2016 timeframe, with a very, very strong resident base, nicest product in that market that's affordable. And in addition, as I just said, focusing on larger communities are still affordable. That community here is actually our most recent community we bought in late February, called Village at Wexford in West Virginia. This is 340 apartments built in 2012 timeframe. Again, average rents here a little bit higher, but around $1,100. And in this market, for nice, affordable, safe community. It's the only nice product out there. And for this market, it's very affordable. Has, nice amenities, as you can see there, nice clubhouse, nice pool, gym, tennis courts, dog parks, but still very affordable. And we see that as a great place to be. And we expect that these types of assets that we own to fare the best through any recessionary environments, including what we're going through right now, and to be even more so what we continue to focus on buying through this next cycle. And we're focusing, though, even when we're buying nice communities like this community, adding value, improving the community, improving the apartments, increasing our returns. And right now, the properties that we were already evaluating, we had a large pipeline already of a couple hundred deals that we were in different stages of due diligence. We're staying in touch with all those deals. We're reevaluating our pricing, being even more conservative to what we expect to happen in terms of physical occupancy and delinquency and things like that. And basically only buying if we can buy at a significant discount, because we think we're going to be in an environment with those types of opportunities here over the next year. So largely we think there's going to be that opportunity because there's going to be so much less competition. So most of our competition that we've competed against to buy assets over the past few years have been institutionally backed groups. So either they have been, public REITs, Wall Street firms, or they've been smaller operators who are basically just sourcing deals for Wall Street groups. A lot of operators out there competing on deals. 95% of their capital comes from some group out of Wall Street, and there was so much capital trying to go into this asset class. I mean, there was $36 billion raised in the last year to be deployed into, value add multifamily by big Wall Street firms, driving up price. Most of those firms, due to the fact that many of them have lost 50% of the value of their companies right now, are on the sidelines right now. So there's gonna be a lot less capital out there going after deals, which is gonna decrease values, increase yields, which we're really excited on the opportunity to capitalize on. And we're gonna leverage, DLP's integration here, all the companies here that work together to not only find these deals and source these opportunities, but then to be able to capitalize and execute on these investments. We put in perspective here, we buy properties, we sell properties, we provide real estate investors with money to buy properties. We do all due diligence service in-house, we do renovation in-house, we do all the management in-house. All of this, though, revolving around providing, safe, affordable housing, which in turn provides repeatable, consistent cash flow to our investors. We do all the integrated components of executing on this investment strategy. This same approach, taking massive action, applies as much, if not even more so, to the lending side of our business. So we've had our highest loan application per week each of the last few weeks. We've broken new records and highest number of loan applications we've ever had. So we've had a tremendous volume of borrowers, really in many cases, top tier operators coming to us, looking for a reliable source of capital, reliable partner. In most cases, groups that we already know, already knew us, already trusted us, but are coming to us even more so now because they need a source of capital that's not Wall Street backed, that's actually reliable and can close and execute on deals. We also have lots of other lenders coming to us, looking to see if they can work with us to fund deals as their sources of funding have dried up. I've had multiple of those conversations today. For the most part, we're not funding any loans with other lenders, as we're really focused on making sure first and foremost, we're servicing our existing loans, servicing our existing borrowers, and using this opportunity to build new relationships directly with top tier operators. But it's been really interesting to see lenders who, felt pretty high on their horses with big Wall Street money, a month or two ago, now with no access to capital. It's unfortunate for many of those lenders out there, but it creates an amazing opportunity for us to pick up significant market share, lending at lower leverage, more conservative terms, only lending to the best operators, buying better deals. It's a great environment for us, for our funds here on the short term and certainly the mid and long term as well. We're taking massive action really in each of our businesses. So in DLP Realty, even though Pennsylvania has been trying to force us to shut down, we're 100% open for business. We're putting homes under contract virtually every day. We're doing virtual home tours through really cool technologies where we can literally walk people through homes. We're doing virtual consultations. People who want to sell their home. We're doing virtual Zoom meetings like this. People are walking us through and touring us through their house over Zoom. We're evaluating and pricing and giving people guidance, getting ready to put homes on the market. In some cases, even putting homes on the market right now. Despite this, we've implemented self-showing lockbox technology so that people can go out and tour homes on their own, even without us as the agent. That's one of the reasons why we've still been able to get tours and offers even in this environment. We're certainly having to adjust to safe distancing for closing. So literally having to have a seller come to a closing separate from the buyer, separate from the title person, not in the room at the same time. So we're having to do some crazy things like that seem crazy in normal times. But we're not letting it stop us. We're not letting anything get in the way of us being able to close deals, get homes under contract, get tours, help people evaluate their options in selling their home, give them consultations and guidance. And we're really excited for certainly what we're closing, what's going on right now, but for the amazing pent-up demand that's going to be here once the stay-at-home orders go away. We've been doing a lot of online virtual presentations and educational seminars. We did one last week for home buyers, helping them prepare, and especially in this environment when there's a lot of noise and a lot of uncertainty, to be prepared and help take a lot of the risk out of buying a home in this environment. Things that we've frankly always done, but becoming even more valuable in this environment. And one of the cool things just last week, maybe it was a week and a half ago now, we were named the 8th fastest growing real estate brokerage in America. And we're the 6th fastest growing brokerage that aren't a big conglomerate, lots of offices. So that was pretty cool. On Bright Homes, we're really fortunate that Florida is open for business. Construction is an essential service. We've been the first Florida home builder to offer smart, energy efficient, net zero homes for rent, maybe at first anywhere, but certainly in the state of Florida, offering these homes like you're seeing these pictures for rent as well as for sale and lease purchase. Again, construction is essential. We're actively right now building over 100 homes, still completing homes, still getting them sold, still getting our permits, still getting our inspections done, and been going really well. We're still also open for business here, raising capital, bringing in capital each and every week, so we continue to gain market share, continue to fund our borrowers, continuing to be ready to capitalize on great acquisition opportunities. In fact, this is going to be our biggest quarter ever in terms of capital raised, as even more so than any point in the last number of years. We're a great alternative to the volatility of most every other asset class, of course, including the stock market and any public markets. Also, more and more people are looking and understanding the difference between a private REIT that we run, our funds are private REITs, versus a public REIT where the value of your investment is based on perception, not based on the value and the income of the real estate or the actual underlying investments, as our funds are set up. Our big fund that we launched a couple months ago here, our flagship $1 billion hybrid REIT, the DLP Housing Fund, is open for business, taking in capital each week, building up capital, deploying it number one right away into loans, but also building up our capital to be able to take advantage of some of these great distressed opportunities that we're going to be buying in the second half of this year. This fund is paying out monthly distributions immediately, 6% preferred returns, 0.5% dividend a month. You can take it monthly or just have it reinvest and grow, build wealth. That preferred return gets paid before we even earn a management fee. We have a 12% annual return target net to investors. That's net of our fees. We've always exceeded all of our return targets. You can invest through IRAs, through qualified money, non-qualified money. This is the fund where all properties that we buy are going into, if they fit the fund. So basically, if it produces income, it goes into this fund. This is the source where all of our deals are going. I am invested, DLP is invested heavily right alongside of our investors in this fund. In fact, we're committed to investing at least 5% of all the capital that goes into this fund. And right now, we're somewhere around 20% of all the capital in the 4,000 plus apartments that this fund already owns. So we're investing right alongside our investors at the same in these same assets that are going to produce great monthly cash flow, great double-digit yields. and the tax shelter of depreciation, as well as a bunch of other tax benefits that we get to take advantage of, including, the REIT qualified business income deduction, including the fact that within this evergreen fund structure, we can take advantage of being able to do 1031-like exchanges and really make this fund as tax efficient as any fund we've ever done, and as any more so than any typical real estate fund. Another way you can invest with us, if you say, hey, right now I just want to get a fixed return on my investment. I want to know what I earn. I want absolutely no volatility. You look at kind of the best CD rates that are out there. We put them on the screen here, and we did this research. So if you wanted to go to a CD, these are the best yielding CDs out there. Goldman Sachs and Bank of Hope and Live Oak and Goldman Sachs has a couple different ones. These are the best CDs right now, 1.85, 1.9%. We have a CD-like vehicle we've been doing at DLP actually for about 14 years now, where we pay out fixed yields to investors. These are guaranteed by DLP. They are not guaranteed by the FDIC, but they're guaranteed by DLP. We pay these returns out every single month for every one of our fixed notes in every period since they started, 14 years ago. We pay out 5 to 10% fixed return based on how much you invest and how long you want to commit. You can do 1 year, which is a new term option we just rolled out. 3 year, 5 years, or you can just do a note that you can redeem at any time with 90-day notice, more like almost a money market type of structure. And you're going to get a fixed yield. You can let that reinvest monthly or take a monthly distribution. You know exactly how much you're going to earn each and every month. So that's a really great option that may be even more attractive to investors in this environment. And this has been one of our main segments of how people have invested with us over the past 14 years. And then if you compare these fixed rates to, savings accounts, you'll see again, the highest yielding savings accounts out there, 1.75%, again, significantly higher returns on a fixed basis. And these are net. There's no fees. There's no expenses that come out of these. These are net to you of all fees. So here at DLP, in short, we're continuing to grow. We're continuing to be driven by our core values, which have been never more important than this environment we've been in here over the past 4 or 5 weeks now. A couple updates here of what's going on from a government standpoint that's affecting DLP and affecting, many Americans. First, really excited that last week, Florida did a stay-at-home order, but that they determined that, and as most states did, that construction and real estate sales are essential businesses. There's many senators and many people pushing the state of Pennsylvania to make real estate sales and construction essential services. Hopeful that that'll get reversed so we can get back to some of the construction and make our sales easier in Pennsylvania. But most of the country, as you'll see here, have made construction and real estate sales essential. All states have made real estate property management essential. You'll see Pennsylvania and then parts of some of these other states have made it non-essential. So we're fortunate every other state we're in, other than Pennsylvania, it's been considered essential services. So as we talked a bit about last week, the Congress did finalize the stimulus program. There's a $349 billion paycheck protection program called PPP. It was short for PPP, which, interesting enough, I won't get too off pace, but for any of you who've known DLP for a while, you know that we call our program here at DLP productivity per person, how we measure how effective we are per person, PPP as well. So oddly enough, this is also called PPP. It's also focused around keeping people productive, keeping people at work. So these applications started just last Friday to be able to apply for this program for small businesses, which are basically companies up to 500 employees, to be able to get, essentially it works out to be 10 weeks of payroll as a forgivable loan, assuming you follow a number of certain guidelines. So there are over 178,000 applications that came in just in the first few days for over $50 billion. We and many of our borrowers were applied on Friday. And I started hearing today, groups getting their approvals in and people expecting to start getting funds early next week. So that's pretty exciting. That's going to help a lot of small businesses, including a lot of our borrowers, provide them with cash flow to keep people employed, pay their mortgages, pay their rent, pay their expenses. So that's really, really exciting. Biggest government, stimulus program, probably best ever built stimulus program for small businesses as well. which is going to have a huge effect and help a lot of people buoy through this time. And then I guess we don't have this slide on here, but then also the stimulus checks and the unemployment programs have also been launched, as we talked about in the past. So now anybody on unemployment, and obviously we keep hearing all the stats, how many people on unemployment, but most people on unemployment are now earning more money than they were earning in their job. If they were earning less than 50 grand a year in their job, they're probably earning more in unemployment than they were in their job. And most of our residents earn less than $50,000 a year. So most of our residents, if they do happen to get unemployed, are going to be earning more. And then on top of that, they say those stimulus checks for individuals earning less than 90 grand a year are going to start getting out here shortly. And each individual get $1,200, children get $500, or I should say, parents on behalf of their children. So a lot of our residents are expecting those stimulus checks. The vast majority of them are, which can really help them not only with their April bills, but their May bills as well. So that's going to be really great as well. Here at DLP, we've been staying very active. Our 340 team members have been very busy. Lots of communication, lots of activity. We're all operating on Zoom with our Zoom videos all the time. You see everybody in different meetings, big and small meetings, people getting workouts in, people staying active, staying face-to-face as much as we all can. It really has been amazing how we haven't really missed a beat. We've implemented new things like virtual tours. So we're virtually touring our homes for sale. We're virtually touring our apartments. We're e-leasing apartments, doing e-signatures on home sales as well. We're doing all kinds of tips and trainings and insight and communication with our residents and clients, doing lots of community outreach, engaging with a lot of outside community outreach programs through our communities to be able to help our residents in the broader communities as well, which has been really cool to be a part of that, getting people meals, especially, children now who were counting on, meals at schools, now being at home, helping facilitate them getting meals, at their homes. A lot of great community outreach we've been a part of. Our team members have spearheaded a lot of really cool things, which has been very awesome. We've stayed very active communicating, of course, to you guys as our investors, doing these webinars, lots of emails, lots of communication. We've been doing the same thing for our borrowers. Nate, who's our president of our lending business, has been leading similar types of content, helping guide and our borrowers with navigating through this environment as well. Speaking on doing lots of communication, one of the things I'm really excited about, you guys will be getting, everybody here on this webinar, I'll be getting communication on this here soon. April 30th, we were scheduled to have what would have been, they always are, our biggest event we've ever had. Our last one, we had about 440 investors come out to our quarterly event in Pennsylvania. And since April 30th is technically, I think, the last day right now of the stay-at-home orders, but obviously not going to be possible, or very likely we can host an event of 500 plus people live on April 30th. So we're moving that event to a virtual dinner party. So now not only will our Pennsylvania investors and prospective investors be able to join, as well as anybody all over the country and world will be able to join. We're expecting to have literally over 1,000 people, probably a couple thousand people join us. We're going to be doing some pretty cool things to have a virtual dinner party on April 30th. So a lot of that communication will be going out end of this week. So keep an eye out for that. And hope to see you then. That'll kind of replace this meeting a couple Thursdays from now, because this is on a Thursday. So we'll skip this webinar and we'll have a dinner party instead. If you have questions on anything I went over here, we're going to open it up to questions now, but you can also reach out to myself, Rich, Larry, Bob, Mike, with any questions. You can call us, send us an email. I'll be happy to chat with you one-on-one on your specific situation, or any other questions that we don't get to here today, or you'd rather discuss on a one-on-one basis. So with all that said, we're going to open up to questions. I've been seeing lots of them come across. I believe Larry's going to go ahead and ask those questions out for everybody, and we'll start diving in.
Absolutely. Thanks, Don. Yeah, so our first question comes from David. His question surrounds current issues that we've seen on a broader scale with servicers and forbearance agreements. So will that affect us, and will the Fed step in to provide liquidity to that sector, in your opinion?
Yeah, great question. So I don't know if I follow the question about servicers. I'm guessing maybe you're talking about loan servicers.
That's right.
So yes, there's been lots and lots of media attention around, forbearance agreements. And certainly, the government-backed programs, Fannie Mae and Freddie Mac, were quick to roll out forbearance programs, as were, a lot of banks. And most of the forbearance, programs, and the reason they were put in place is to really help the businesses that were drastically affected. And those are, hospitality and, restaurants, type businesses first and foremost, and then certainly, retail and office. But some of the really hit asset classes, if you're in hospitality and you're literally sitting on hotels with zero occupancy, it's going to be hard for a lot of those sponsors, those operators, to make their payment. So I think it was, smart and made sense for a lot of those lenders to quickly be willing to offer forbearance agreements. And certainly nobody knew, and nobody still knows exactly, but I think we're all getting a better handle how all this was going to affect, multifamily and affect housing. I think for most, we can confidently say it has not been nearly as bad as what most expected. But I think what the media doesn't mention, and what a lot of people have a misunderstanding about, is if you say Fannie Mae as an example, or Freddie Mac, if you own, so we have a bunch of Fannie Mae, Freddie Mac loans, and if you go and you take a forbearance agreement on a property with Fannie Mae, number one, you can't pay your investors. So you can't be distributing out any cash flow to investors if you're not paying your mortgage payment. So of course, unfortunately, for a lot of other fund managers, investment managers, they don't have money to pay their investors anyway. So that's not really as much of a problem. They are fighting for survival. But also, you can't evict a tenant if you're under a forbearance agreement. So you're going to end up compounding your issue by not being able to move out residents who can't pay either. And most of these forbearance programs are not a waiver of payments. They're a deferral of payments. A lot of banks, what they've done is they've allowed borrowers to just pay interest. That's been kind of the first thing they do if they're on a principal and interest loan. All of our loans to our borrowers are interest only anyway. And then most cases, what they're doing is they're taking that payment they don't make in April, May, and they're then amortizing it over the next 12 months. So now that sponsor, that operator, has to make his normal payment plus catch up on what he hadn't paid before. So I get it. If you're in an asset class where you have no other option, it makes sense. The good news for us as a lender is that almost all of our loans are short-term bridge loans. They're not long-term loans that are based upon cash flowing the property. It's not the purpose of the loan. The majority of the loans at the time of our loans, these are not even income producing assets at that time. They're transitional assets where, again, the sponsor wasn't counting on cash flow to make their loan payments to us. So in short, we are not doing any forbearance agreements related to deferring payments for our borrowers. And the vast majority of our borrowers have already paid their April payments. And we'll work with them. We'll be more patient. We'll be more flexible. We'll work with them on extensions and things like that. But we've expected and our borrowers have understood that our payments are due, so we have to pay you guys as our investors.
Awesome. And along those lines, Don, how do we see the profitability of the fund, the lending fund specifically, going forward in terms of pricing and profits going forward, as well as do we expect to have to increase reserves at this time?
So in terms of the yields on the fund, our challenges right now in the yields of the fund from historical is mainly related just to cash. So kind of, as I said, two parts to that. Number one is we're needing to be more conservative and having cash sitting for a few reasons, including number one, we can't expect to have as many loan payoffs, even though we've been having a pretty great amount of loan payoffs. So we have to be more conservative that loan payoffs are going to take longer. But then also, right now we're not utilizing, over this last month, we have not utilized any leverage. Normally we use warehouse facilities as cash management tools that we can draw and leverage loans. Right now we're not doing that. We're minimizing leverage right now. So less leverage, and then in turn needing to hold on to more cash. Those two components are what are affecting our yields. On the positive side, what's affecting our yields is new borrowers that we're funding today. We have increased our interest rates by about 1%. We've held our interest rates for our current borrowers. So that's going to help our yields overall. But in short, what we're expecting, what we announced here actually in this format a few weeks ago, is our return target to the lending fund, income and growth funds have always been at 11% for the last number of years. We have decreased that target down to 10%, with us still paying out 10% preferred return to investors on the first of each month. And I can tell you in March, we did generate over 11% returns. We're finishing up that reporting right now. And we're going to keep pushing to do so. But we just wanted to be a little bit more conservative. So we are very, very, very confident we will continue to exceed 10% returns with monthly distributions net to investors, through this.
Awesome. Sticking on the lending side, we have a lot of great questions here. You mentioned other lenders who've approached us for capital. So could we share some examples of what that looks like, as well as if we are to lend to those other lenders, how do we maintain the high yields on those sorts of scenarios versus, for instance, doing a direct loan to an investor on a property?
Yeah, it's a great question. So how it looks is, a lender would come to us and basically at this point be a broker. So they would, broker that loan over to us for us to fund. And then generally how it works with a broker is they would get to keep some of the origination fees. There are other forms of kind of lender relationships where they'll actually share in the interest of the loan. That's not something we currently do. So the broker bringing us a deal or another lender bringing us a deal will not affect the fund's yields, and the fact that the fund won't share any of that interest income out. We as direct lending partners would have to share the fees that we earn that pay our bills, pay our salespeople, pay our rent, pay our marketing, etc., with that broker generally. But that's actually not where we have we have a problem per se. What we try to do is we believe very strongly, and that's actually in this environment, it's never been proven more valuable, that a big part of our strength in our lending is the relationships we build with our sponsors. The fact that we really know them, we really underwrite them very deep. We get to know them personally in almost every case. We end up spending face-to-face time with them. We really build close relationships. And then we also by building that close relationship, a lot of the value we bring to them is the education and the training and the resources and the tools and that we give to them above and beyond the money. So we know for us, our value proposition isn't just our money, and never has been. In order for us to maintain those relationships with the best operators, we have to bring a lot more value than just the money. So generally when a broker brings us a business, it's just transactional. And we don't get the benefit of getting to know that operator, getting to build a long-term relationship, which we find very important in mitigating risk. And then also that's the other component when business comes through a broker. Brokers, and there's many really good lenders and brokers out there who are wonderful, but a lot of cases they know how to package up information in a way that makes the borrower look really good because they're professionals at doing it. And they can kind of package up a load of crap, I don't know a better way to say it, into looking really, really good because that's what they've learned how to do, and they know what a lender wants to see and wants to hear. And that's why very little of our business has ever come from brokers. We much rather be getting all the source documents directly from the borrower, talking directly with the borrower, asking them questions, understanding their business, understanding the strategy. So that's why we've really always stayed very focused on working directly with the borrowers. And that's why we feel so confident right now that borrowers aren't coming to us and looking at us, hey, this is just this big lender backed by Wall Street, so who cares if I make my April payment? Let them deal with it. I'd rather keep the money. They know us. They have relationships with me, with Nate, with our salespeople, with our team. They think of us as partners, and that's why they feel paying us is important. And they're not thinking of us like some big bank that who cares if they make a payment or not. They understand. They know how we're structured. We share with them. We teach them how we work with our investors. Heck, we probably have 20 of our borrowers in this meeting right now. I know we have a lot of them in this meeting right now. They understand, that if they don't pay us, we can't pay our investors, and then we can't keep lending them money. And they understand the circular event of that. And and they want to build relationships with us. They want us to be a partner. And that's another big part of things is the fact that we're continuing to be in business and we're going to stay in business. We're going to continue to be a partner for them adds additional reasons why they want to continue to prioritize us above everybody else, because they look at us as a long-term partner, because we're still here for them. As everything's going on, other lenders we've heard and seen other lenders who can't even provide the borrowers with the draws that they're obligated to provide because they don't have the cash to do so, and putting borrowers in a very bad position because they can't fund their draws. I've had a lot of borrowers come to me saying, "Are you guys going to be able to fund our draws this week because their other lenders can't?" And that's a really big problem if you're putting your borrower in a position where they can't execute because they can't get access to the money that they're owed. That was a long answer, but I hope that gave some color.
Awesome. Great. So yeah, let's go ahead and move forward here. We have a number of questions regarding more of the housing fund side. So the first question that we have here from David is, do we believe that post-virus with social distancing behaviors continuing, will they have much effect in the multifamily side versus single family residences when it comes to our rentals?
It's a really good question. I can tell you I have not seen, in terms of, I think where the question was going was, with multifamily, the fact that you're living next to other people, are people going to be concerned with wanting more space, and wanting to be in a single family home to have more space? I think that's where the question was going. So in short, I have not seen that in any way, shape, or form. I mean, we picked up last month, the month of March, in the midst of this pandemic, we increased our physical occupancy across our portfolio by 3%. I don't think many people are thinking about this, that this is a new way of life, social distancing. I think we all, or at least the vast majority, know that this is a short-term situation that we're all very anxious to be over. So no, we have not seen that kind of thinking. I'm not saying it doesn't exist in the minority per se, but have not seen that in any major way, that were heard that people want to go to single family over multi. And we haven't heard, residents wanting to leave our apartment communities to go to a single family home because they don't want to be so close to other residents. I think in these environments, in many cases, they appreciate being in a community in this time of social distancing where, they're in a community where they can go out and walk, go for a walk, go for a bike ride, et cetera, and not have nowhere to go. Like say if they're living on a single family home, out on a main street or whatnot. I think they've also recognized and appreciated the value of, when they had something go wrong with their apartment or service order, that our people are still there. We're still there helping them. And despite all this, they can get support, that we're helping them get food. We're helping coordinate, services that otherwise they could feel kind of, stranded in some situations. So no, I have not seen that at all.
Awesome. So as far as Bright Homes are concerned, Stuart had the question about, are the Bright Homes and is the Bright Home strategy a part of the housing fund? And if yes, do we have a target percentage of what that would look like as part of the housing fund? And if not, what is the investment vehicle for the Bright Homes side of the business?
Yeah, great question. So the short answer is yes. Bright Homes for Rent, the homes that we rent, will be a part of the housing fund. That's just happening now. We just started leasing our first Bright Homes this past month. We leased a number of our first homes for rent. So yes, those will go into the housing fund. Will be a part of the housing fund. Be a great way to diversify our rental income, our exit strategies, our approach, and generate very comparable yields to what we get in multifamily. So we're really excited about that. We expect over, of course, all these numbers in terms of kind of our targets we set for the year, everything's a little bit in flux until we know when we get through everything kind of going back to normal. But at the start of this year, the expectation was that we'd put 156 Bright Homes into our rental pool this year and grow that next year. So in terms of dollars, we haven't set an exact allocation kind of limit per se, but I would anticipate it be somewhere around 3 to 5% of the housing fund capital at this point. That'll, call it 12 months from now, that'll be in Bright Homes.
Excellent. So a little bit more about the fund itself. an attendee had asked, with the new fund having, you know, a 6% preferred return, but the goal of 12%, you know, unlike our previous funds that have had a term life of 5 to 7 years, you know, where there was a liquidation at the end, since this new fund is evergreen, you know, how does an investor benefit from the appreciation of assets, you know, if they sell their holdings within years, you know, the first 3 years, or, you know, essentially, will they miss out on the sale of a bunch of assets in year 4 then, therefore affecting their overall return because of the evergreen nature?
Yeah, a great question. So the incomes, first I'll cover the income streams of the housing fund are going to be number 1, rental income. Number 2, interest income on loans that we make. And then number 3, the profits on the sale of homes. Those are going to be the 3 main income streams of the fund. So we will be selling, you know, apartments, you know, very likely in the very first year of the housing fund. One of the great things about this fund, especially kind of, you know, kicking it off, is we're already seeding this fund with over 4,000 apartments that we already own, that we've acquired over the past 12 to 18 months. So we've already seeded the fund with a great portfolio. It's already producing cash flow and already is in the stage of value add and being stabilized and moving towards our ability to have the option of exiting that asset. So I want to first mention that. But in terms of how, you know, if you decided to exit out of this fund on year 3 or year 4, how you would take advantage of the increase in value of the underlying assets. So throughout the fund, you know, we're paying out the 6% preferred return every month, and then at least annually, we're paying out all the additional profits that we've actually realized and earned from the sale of homes, from rental income, from interest income, everything over that 6% that's been realized. You know, we recognize and pay that out to you as investors in the fund. In addition, every year, you know, we're going through and producing an updated value, a NAV value of the portfolio. And then, so then at the end of each year, we'll have an updated overall value, and that'll then set the value for the next year for what investors come into the fund at, and if you wanted to exit, what you'd be able to exit at. So in simple terms, if you invested in at $1,000 a unit, which is the unit price, and let's say all the assets went up on average went up 10% in value over the year, and then, you know, next year you wanted to exit the fund, you're going to get to exit out at that 10% increase in value, plus have been able to keep the realized gains that we actually generated from selling properties, collecting rent, collecting loans, et cetera. So it's a way that we keep it fair. The new investors get to come in based on where value's out at each year, and investors already in can exit at that same value that we set on an annual basis.
Awesome. So we have a question here from Keith. Do we have anything similar to stress tests or minimum cash reserves that are behind our funds, you know, specifically obviously the lending fund or the notes, as well as the housing fund?
Yeah, great question. So short answer is yes. Longer answer is, you know, it's a little you know, kind of complicated per se to just say, hey, it's an X percentage, because, like, example, in the lending fund, you know, we have renovation draws that we, in our loans, that we're committed to funding over the X number of months for them to complete that renovation. So there's, you know, components like that we have to be able to plan and budget for. So, you know, I guess in simple terms, you know, we're budgeting to make sure we have enough cash on hand to kind of cover all of our obligations for the next, you know, 4 to 6 months is the short story. And that's without factoring in, you know, prop income coming in, loans paying off, new capital coming in, leverage, et cetera. So that's a kind of really quick way to say it. In addition, the lending fund, income and growth fund, et cetera, have reserve accounts built into the funds to set aside reserves if we ever did have any losses on a loan that would cover those losses. So it's pretty sizable reserve accounts that are set up in each fund. We've never used those reserve accounts ever. We've never tapped into them. We've never written off $1 on any loan. But we also have those as another form of reserves as well.
Awesome. We have just a couple more questions here from the group. So the first question here is from Dan. He said, how is the housing fund going in terms of capital raising to date?
Going well. We only officially started taking in new commitments, I guess maybe 3-4 weeks ago. So we had investors who were already in our preferred return equity fund that had the ability to transfer their capital over to this fund, which the majority did, and that seeded the fund. And then we officially opened it up. I guess maybe it was the first week of March, somewhere right around there, for new capital to come in. So yeah, we've been having good capital flows coming in, despite obviously this is a kind of, in some ways you could say, a really tough time to launch a brand new fund, but in other ways a really great time, because this fund, the fact that we can do debt and equity and the way it's structured and built, was really built for volatility, built for kind of change in the environment. So it's a perfect fund for this environment. Perfect ability. Like right now, we're not acquiring any properties right now. So this was just a multifamily equity fund. Well, all investments coming in right now will just have to sit and wait till come Q3 when we start buying properties. But because we're also making loans and we're having great opportunities to fund really great low risk loans, we can deploy that money into loans, and our loans pay off so quick that we're going to be having maturities, and then we can use that money come back in to fund acquisitions come Q3. And so it's a really great structure that allows us to deploy money quick and be ready to build up cash for large acquisition opportunities. So I don't know the exact numbers offhand. I can definitely have that on hand for a next week meeting, but I know I see the commitments that come in on a daily basis, and we've been having money coming in just about every day into the housing fund, which has been awesome. Really, really excited, because we very much, that's why we set this to be our biggest quarter ever in capital raise, and we expect the fund to bring in the majority of that capital is going to be the housing fund, because we know we're going to be in an amazing situation to buy, come the second half of this year.
Awesome. 2 questions left here. So number one, it's a great question from Chris. So in your opinion, what are some of the critical due diligence items for investors to take to protect themselves from things like Ponzi schemes in this distressed kind of marketplace? Times like these are certainly times when people can take advantage of folks. So how do we get ahead of that, and how do we show our transparency in the way we operate?
Yeah, so that's a great question, and I agree. This is definitely a time when people are going to be facing a lot more distress than normal, and people will stretch the truth to get investments, I guess, the best way to put it. And and I'll say this: I mean, we have a lot of investors who've invested heavily with us, and I say this as humbly as possible, but we kind of make it. We hear this a lot. We make it look so easy to generate the kind of consistent returns that we generate to our investors, and that a lot of people think just must not be that hard, and they go and they invest in some smaller operators who promise even higher returns, and we've heard some of our investors who go and they invest in individual lending on their own, or even second position lending behind a lender. Bridging gap for guys. We see people doing these types of things with smaller investors who tell a great story and promise really high returns and promise them a split of the profits and get burned. And we've seen that even in this really good times that we've just come through. And you're going to unfortunately have more of those types of situations here in a stress tested environment like we're about to face. So what I would tell you, is do your homework. So one of the things we pride ourselves on is first our investor portal, and the fact that you can see our audits, you can see our financial track record, you can see our financials. It's very easy to do that research and verify the properties we own, the loans we make, just on Zillow alone, and get an understanding to what we do and see the track record. Number 2 is doing things like coming to this, but coming to even our dinner events. I know next one's going to be virtual, but even in the meantime, a lot of people come to our dinner events as an opportunity. I think this is one of the biggest tests to say that, I think a lot of people feel the same way, to prove that we're not a Ponzi scheme. As an example, is we sit our prospective investors at the same tables with our existing investors at all of our events. Like literally, you go to most of our events, we have more existing investors at the event than prospective investors, and then we put them at all the same tables on purpose so they can talk exactly on their experience. And so I encourage you to take advantage of those events, but also we do this for investors all the time too. We'll gladly, we have literally dozens. We have, dozens on this call alone, investors who would be happy to be a reference for us right now. I have some typing that in the chat box right now. So we have many investors who'd be more than happy to jump on a call and tell you about their experience and what they've done and how it's gone and so forth. So that level of transparency, to see our financial transparency, to talk to our investors, and then not to mention, I mean, obviously when you in this stuff, I think anybody should do, when you're investing, making any investments, whether it be a capital investment or, hiring a contractor or whatnot, doing your online research and hearing and listening to them like you're doing right now in an event like this, but doing your Google research and seeing if they look legit. Do you find information on them? Do they have good reviews? That type of stuff is meaningful, and it gives you a great test. And then I think the last part of it, to me, and this is probably the hardest part for most people, is the comfort with the guys at the top. And at the end of the day, do you truly believe that the person who's ultimately, or the people who are ultimately going to be running your investment, running your money, are good people? Are they Christian, or whatever you want to call it, faith-based people who you believe are going to do the right thing in good times, and way more importantly in tough times, and are going to put you first, and are going to make sure you're protected, are going to be honest with you, are going to be transparent, are going to run towards situations and challenges and communicate versus hiding and not being able to get a hold of them. So I think those are the things I'd be thinking about. And I make investments with great managers all the time. We do it as a lender. We do it investing equity, in partnerships, and then I do it personally in some of my personal investments. I invest with, different managers and different asset classes, and that's, to me, that's a big part of the day, is my comfort and understanding of the people ultimately making decisions are the types of people I'm going to trust and are going to make the right decisions. And there's scam artists out there, but I think more times than not, when things go south and somebody turns out to be a scam artist, you think back, you realize, yeah, I didn't really trust that guy from the first time I talked to him, but it just sounded so good. I figured it is worth taking that risk. So, I think that's an important kind of, heart check or gut check to always take before you make an investment.
So that's our time, Don. Those are the ends of the questions then.
Awesome. Thanks, everybody. We'll do this again next week. Feel free to shoot any questions in, as some of you have been doing, and that's why we covered some at the very beginning. But appreciate it. I know we went over on time, but also awesome questions, and I look forward to talking with many of you again next week.